Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. The fifth Monday of March, which would make it March 31st, 11 a.m. on the East Coast. Dan, Nathan, Guy Adami. Before we start, this is market call, by the way. If you do remember, before the tournament started, Dan, I said to you, this is going to be the ultimate chalk tournament. And as we sit here, obviously 4 number ones in the final 4. But if you go back to the Elite 8, I think there were the obvious 4 number ones, 3 2s and 1 3. It doesn't get more chalky than that.
Yeah, Bill Hockman, our main man here, we were talking about it this morning. We're like, is it the portal? Is it NIL? He said, yeah, it's like the NBA, like, I don't know, minor leagues or something like that. It's getting fairly predictable. Does that make some sense, Guy, in the March Madness? It ain't so mad anymore, I guess.
Makes sense. Another term I don't use is you notice I called it the NCAA tournament. I'm, the madness.
You can't do the March Madness. No, I got you, Doug. Another word we talked about that we weren't going to use a whole heck of a lot last week.
Interesting.
By the way, Timmy put together a great little TikTok, a great little reel with you. You had little like emojis on your head and whatever they call them, that sort of thing. I don't know if it's funny. I don't know if you opened the.
I did. I thought it was cute. Yeah, it was well done. Well produced.
So Guy, you and I, we did the Risk Reversal podcast. Listen, this is a big week. It's a big week because, like, for instance, Doug Cass just pinged us and he said he's starting to cover shorts and buy. And he's been trading this pretty well. He kind of and timestamped everything Doug does on thestreetpro.com. Timestamped. He started buying on the way down to that 5,500 level. Maybe it was like 5,770. But the way the volatility bands have widened over the last few weeks or so, you start buying at 5,570 and you kind of go all the way to. That's a good trade. I mean, like on its way up to, you dollar cost average into that sort of thing, and you try to be nimble. I know a lot of folks aren't all trading that way. They're not all that nimble, but if you're watching Market Call and it's live here today, you're probably more interested in some of these intraday moves or multi-day moves or something. Are we approaching that as we get close to 5,500?
Yeah, well, again, we said last week the VIX was going to remain a story, and we got a VIX that got south of 17 at one point last week. And as we're sitting here right now, I think you have a VIX that's either side of 23. At one point today, I think it was north of 24 3/4. So the VIX is a story. In terms of the move, since the opening this morning, we've seen probably a 50 handle bounce in the S&P 500, which, at a VIX at this level makes a lot of sense. We traded down effectively to that prior low that we saw on March 13th. We sort of overshot it a little bit. You want to throw an S&P chart, there you go. You can see what I'm talking about. So now it's sort of the rub. I mean, are we going to bounce back to the 200-day? Or, what's going to happen at these levels? I think we're going to sort of chop around here. But if I'm being honest, which I try to be, I think there's more pain to the downside. Along the way, you're going to get these types of bounces that if you've bought it, you're enjoying right now. But that bounce that we saw from the March 13th low, I thought we'd get to 58 1/4. We got to 58.05. So that was pretty close. And now here we are rolling over again. Not that anything makes sense, but these moves have actually made sense to me.
Yeah, let's go to a 2-day chart here, man, if you want to pull that up. So obviously this is, something to kind of show. There you go. So you see that gap. Listen, we talk about this with Carter a lot. I mean, gaps in the S&P have not become that common, especially on the sort of like, as our main man, Brian Belsky, on the Risk Reversal podcast that dropped on Friday, said that he still thinks we are in a secular bull market, right? So if you go back to the lows in October of 2022, we've had this really nice rally, 23, 24. We had 25% years, performance, 2 consecutive ones. And you look at that and you see like people have been trained to buy dips, and that whole way up, we never made a lower low from those October 2022 lows. Here's, a 5-year chart that we're looking at that shows that bear market. And, we just broke that that uptrend that had kind of been in place from late 23. So, when you talk about the levels and banging around there, you do have that 200-day moving average that could serve as resistance. You see that uptrend that had been in place from late 23 that we just mentioned. Do we get down towards 5,400, which is kind of the next level? Let's go to a 1-year chart really quickly again. And then this is obviously just technicals. Nothing else really matters. You see a couple of those gaps there. You see 5,400, which is that level in September. So do we hold there? Is that important of a level? Not really, Guy. That August 5th, that intraday low is probably the one which comes in. What is that, 5,100
51, 5105 or 50, whatever the hell it was. But yeah, so it's something with a 51 handle on it, that August 5th low that we saw that Monday. So does that come in play? Yeah, I mean, I'll say that's going to come in play. And if I'm wrong in a month and a half, or however long it takes, so I'll be the first one to say it. But I think what should be concerning for people, well, there are a number of things to be concerned about, but just on sort of technicals, for the first time in a while, you have this flattening out of the 200-day moving average. I mean, when we've been in this uptrend seemingly forever, obviously there was never really in time or an opportunity for that to take place. But with the weakness we've seen now since effectively February, you're starting to sort of flatten out. The concern obviously will be if we start to roll over, because that would suggest a change in direction. So I think we're already in the midst of that. But in order to get confirmation of that, you need this 200-day to flatten out and to start to sort of skew lower, which, we're on the precipice of doing for the first time in quite some time.
Yeah. So let me ask you this, because I've had a few of these conversations of late. Folks were talking about 2022 and the conditions for that bear market. And, we're talking a lot about it in late 21. We thought there was a lot of froth in the market, and there just was. And you could try to compare some of the froth that we had seen over the last year or so that drove a lot of the performance in the S&P 500. It was in some of the biggest names in the market. It was around one of the biggest secular shifts that I think we can all agree is probably going to be here for a while, whether we see the sort of multiple expansion in some of the biggest beneficiaries and some of the growth that we've seen year over year in those names that were driving a lot of the performance, the S&P 500, anytime soon, whether we see it again. That's what I mean. Who knows? Here's the Faithful Eight. I don't know why she keeps calling it Dan's Faithful Eight. I think it's our Faithful Eight, Guy.
No, she's right in calling it in Dan's. I'm not,
So what's different now than 2021 is that, again, these stocks, these EPS revisions higher over the course of, let's say, 23 into 24, were driving a lot of the performance of the broad market. Last year, NVIDIA accounted for 25% of the S&P's gain. Going back to 21, it was SPACs. It was just a bunch of NFT and crypto shit. It was a bunch of non-profitable tech and everything like that. And we were just saying, like, this ultimately will burst. We had no idea where it was. Also, really importantly, the first week of 2022, this was after the Fed had already signaled they're going to raise rates to battle inflation. The S&P made a new all-time high. So flash forward to where we are right now. I have no idea how low this sell-off is going to go, right? Right now, the S&P, if you think about it, is down less than 6% of the year. The NASDAQ's down about 12% of the year. And the RSP, that's the equal weight S&P, is up, it's only down 2%, right? So it seems, I don't know, it doesn't seem that bad at the moment, considering all of the headwinds that we have right now, whether it be inflation, whether it be rates, whether it be a trade war, whether it be geopolitics, that sort of thing. I mean, we're still kind of hanging in here. So even if you go down to 5,100 from here, you kind of have that run of the mill down 15% peak to trough decline if we were to stop there. And again,
historically, there's nothing wrong with that at all. I mean, and what I always find amusing is people, for example, let's say that Guy Adami has missed the entire move higher, and Guy Adami says, I would relish the opportunity to buy a pullback in the market. And, it makes sense in terms of just thinking it through until it happens. And as we say all the time, the reasons why are always scarier than you could have ever envisioned, and you wind up doing nothing. And that's going to probably be true here as well. Obviously, there are a lot of scary things out there, but what we try to tell people all the time is you try to divorce yourself from the emotion around it and you try to stick to your levels. And if you have a sort of line in the sand for individual names or the broader market, you sort of stick to it and see how it goes, understanding the circumstances to get there probably going to be not what you envisioned. I mean, it's a good example, by the way, is Tesla. We thought it could get down to sort of 235. It overshot. We thought it could bounce to 285. It got there almost to the number. And then you've seen the subsequent pullback. So, what I try to do, and Dan and I differ on this, but you try to take emotion out of the equation and just sort of stick to your levels. And most of the time, I think you're going to be successful doing that.
That's a great point. You rely a lot because you're a former commodities trader, right? And we're going to talk about crude and gold, and people ask us, well, why do you guys spend so much time on the charts and some of these indicators that you look at from a technical perspective? And, back then, I mean, you had a handful of inputs from a qualitative standpoint that you would focus on, right? But then you would also rely a lot on technical levels. Why? Well, a lot of the customers that you were dealing with, a lot of proprietary risk you were dealing with, you're trying to game out a little bit about where folks are going, where their stops are, that sort of thing. And a lot of people look at the same indicators, which is why you better be up to speed on this, which is also why when Carter was with us, more frequently, I mean, he spends a lot of time using that 150-day moving average. One of the reasons why he's trying to differentiate himself a little bit from all those folks that use the 200. But one of the things that's interesting, and you and I have been looking at this for decades now, the 200 to me lines up more frequently, towards the levels that I'm focused on from a technical perspective. While I don't start with the technicals, I start with fundamentals and catalysts and the like. So that's why the 200 is so important to me when I think about the technicals. But you would also make the argument, sometimes I'm too focused on what I think the fundamental case would be. And I oftentimes have the ability to be right on those narratives. But if I'm wrong because of my timing, that makes you wrong in the markets. That's sort of, but I'd much rather, for me and the way I operate, I'd much rather have a really good handle on the fundamental story, especially when it comes to an individual name or a thesis that's driving a big shift.
Well, think about that. I mean, for example, what you did with CoreWeave, and you had that really deep dive understanding what was going on. They IPO on Friday. The IPO does not go well. I mean, it's interesting to hear the CEO talk about market conditions did not help, but I would submit, and I actually said it on Fast Money, the market conditions that he was concerned about were created by the failure of his, and when I say failure, I'm choosing to use that word. I mean, in today's world, opening at 40 effectively and closing right at the IPO price, I think by any stretch is a failure, especially when you had to downsize the amount of the offering in the first place. So my point is, you did the fundamental work around that, and you came to a thesis that played out. You can never underestimate the importance of fundamentals, but it's also important to sort of overlay it with technicals, because a lot of times, they will line up every once in a while and they will diverge, and you're just trying to sort of marry the two.
Yeah, and we've been trying to talk about this shift. It's like in 5 years from now, generative AI is going to be a part of every sort of company's strategy, from a productivity standpoint, from how they interact with their customers, to like some of their biggest kind of selling products and the like here. And, I get that, you get that, but what we've been trying to kind of take some of the air out of is the euphoria in and around a handful of names that have meant to be benefiting from it, not just in the public markets, but often in the private market. So if CoreWeave is some sort of sentiment, sort of, I don't know if you want to call it a benchmark about how some of this private stuff might come to market, what the perception will be as it relates to their competitors, their customers that are already in the public markets. That's why this is important to me. But here's a story. Again, here's the qualitative. This is from March 29th, right? So this is from the information. Some large cloud customers slow down AI spending as prices drop. And it goes through this whole, I'll just read it to you really quickly. Palo Alto Networks last year started adding artificial intelligence chatbots to its products to help customers get answers about their network security. The tools originally relied on state-of-the-art models from OpenAI and other firms, but Palo Alto recently found that open source models from DeepSeek, a Chinese developer, could handle the same tasks for just 5% of the cost. I mean, this is why people freaked the hell out on January 27th, okay, when DeepSeek's data came out. If you're not tracking this and you wake up today, okay, about some of the narratives about this shifting sort of secular, dynamics and stuff like that of generative AI, all the stocks that have accrued most of the value of this generative AI trade in the public markets over the last 2.5 years are all down at least 25%. Every single one of them. Now, I'm not saying, Belsky said to us the other day on the pod, did you sell? You know what I mean? Now, I'm not overexposed to this sort of stuff. You could say the QQQ and the S&P 500 has a lot of exposure to this. So if you're kind of pairing some of that or hedging some of that risk, sure. But like understanding these dynamics, I think are really important.
It's vitally important. You have to have a modicum of understanding at least. Now, for a long time, people made money just not even understanding, not knowing what the companies associated with the letters even did. And that was okay for a period of time. You just sort of throw in darts, and there was a period of time where that really worked. But over a lifespan of this, you have to have some understanding of what you're buying, what you're selling, and the reasons why behind it. And, we try to a certain extent that we can, we try to sort of do the heavy lift for you. And then you make the decisions based on either agreeing with us or disagreeing with us. But let's take a look at the sectors today, because I think the year-to-date change is going to surprise some people. I mean, energy sticks out like a sore thumb to me here, Dan, up 9% year-to-date, which, that was sort of left for dead last year. And a lot of people coming in this year thought there might be a chance. But here we are, sort of energy leading the way. The other side of that coin, obviously, is technology that we've just talked about for a while. And I don't think for most people that are not watching this as closely as we are, I don't think people would have seen that kind of divergence.
All right. So question from Dan N. I don't think it's in the.
Is he on the list? Is that on the thing?
No. Does 9% on the year for the XLE? We just talked about how much the S&P was down, and the NASDAQ's down 2x that, and the equal weight is down, 2% or something like that. Does 9% gain on the year signal to you something different than your take on the economy, on Chinese stimulus, on Middle East stuff, calming down, you know what I mean, OPEC stuff?
Yeah.
What do you think that is? It a snapback just because folks are just thinking about I don't know, like I don't know. I'm just at like
it's got nothing to do with the economy, because I think most people would agree, if they're looking at the numbers, the economy has been slowing at a pretty considerable pace. I mean, we've seen some of the numbers coming out, some of the forecasts. I think Goldman Sachs just lowered their growth forecast as well this morning. So it's not predicated on the economy. I think to a certain extent, it's been a rotation out of higher priced, higher valuation names into more reasonable valuations here. And I think it's a money flow thing. So I don't think it's got anything to do with tariffs. I don't think it's got anything to do with the economy. I think it's got everything to do with people getting out of names that they've been successful in and finding their way into names they can actually make a reasonable argument on valuation for, and that is energy.
All right, so here's another one. So Goldman's out.
Dan N or no?
No. It's from Dan N. I'm just making a comment here. So Goldman, it seems like every Monday we walk in and, a lot of these strategists have new posts out or new pieces out, and Goldman is cutting their target in the S&P 500, and they're raising the probability of a recession. I think their long term here, they go from 5,900 in 12 months. No, I got that right.
I think it's 5,700.
So they're taking it down, but they're raising their recession probability. A lot of that obviously has to do with trade, tariffs, and the like here. So when you see that sort of probability, they're also saying that the average stock market decline in the S&P 500 is about 25% during a recession. That's basically kind of what we had in 2022 at the lows. I think we closed down 22%, but we did not have an official economic recession. We had an earnings recession. So we will have an earnings recession prior to an economic recession. The market will probably have already bottomed by then, right? You know what I mean? So is this recession starting to become something that could be, and I think you use this expression, sort of like a foregone conclusion once people start getting it in their heads and they pull back a little bit from spending, whether you're a corporate or a consumer, because of the uncertainty around
I've always been fascinated by people's just sort of like they froth at the mouth. Are we in a recession? Are we going? I have no idea. What does it feel like? Just ask yourself a simple question, like, how do you feel about things? Like, do you feel good about things? To me, it's a very personal thing. Yeah, the data is what it is, and statistically, 2 negative quarters in a row and stuff. But does that change your way of living or your lifestyle, knowing that we are about to enter one? I've never really understood it. In terms of the market, I think it's saying exactly that. I mean, the market will have discounted either being in one or getting through one long before people start talking about it in earnest. I think what people should be more concerned about is, where are we in terms of the valuation cycle, and where are we in terms of sort of the earnings cycle? And those are the two things that I think should be somewhat concerning, because I do think you're going to start to see a slowdown in the consumer, which almost by definition means you're going to see a slowdown in earnings. And what are you willing to pay for those earnings in a slowing environment? Those are sort of that's the calculus that I think you have to start to figure out.
Yeah, no doubt. But I think a lot will be known by the end of the week, by Friday's close. You think about, we have this April 2nd tariff deadline. Then we have the March all important jobs number, which I know that you're going to be like humming the final countdown right until you get to that 8:30.
I
Because
don't
Becky's
hum.
going to be like, when we come back,
When we come back. First of all, if you're humming, my grandfather used to hum.
Final
And
countdown.
it's funny. It's not funny. This man was he was in the Italian army prior to World War. Not that nobody gives a shit about this, I understand, but he was in Mussolini had a private army in the 1930s. My grandfather was in it,
Really?
and then he subsequently came to the United States. The man drove tanks. He was not able to drive a car here in the United States for some reason, and he wore hearing aids, and he always used to pretend he didn't hear. He heard every friggin' thing. But my grandmother was the driver, and she was a shitty driver. And when she got particularly shitty, he would be in the passenger seat, and his humming would get louder. So to this day, people that hum, I just want to throttle. Back to you.
Wow. I mean, I think the most important or interesting part of that story was that your grandfather was in Mussolini's private army.
There were about 100 or so people. I have a picture of him with his compatriots, with Mussolini sitting in the middle. Ask my son. He's there. He's seen it.
That's
amazing. Really interesting. When he came to the United States, the FBI followed him around for a period of time.
I was going to say, and I'm not comparing him to like an SS or anything like that in Germany, but Mussolini and a lot of his close, they hung. You know what I mean? Like there's a spot in Rome where they show you where Mussolini was hung in front of all the people, and they left him there for a while. That's crazy. I'm really interested in hearing more about that offline. But in the
you brought up humming.
I know, because you're going to the final countdown.
Or people that whistle. It's like
CNBC, they play that the first Friday of every month around 8:25. Our main man, Joe Kernan, and Becky Quick, they got a 10 box up there of all these people are going to comment on the jobs report. Do you think that we have like made these things so much bigger than they're meant to be because of
100%. And there have been people that speak to that. Listen, I get the production value of it, but somebody like Jamie Dimon talks about maybe the Fed and maybe these numbers in the here and now are not nearly as important as we'd like to make them out to be. And I get it. You got to sort of, I don't want to say drum up interest, but you got to create interest around events. And those are obviously pretty big events.
Yeah, but when I started in the business, if I told you like we were sitting on the edge of our seats waiting for a jobs report or some sort of ISM number or even the Fed, I don't think the Fed were doing those pressers back then. We just weren't, like at all. And so I think a lot of it had to do, and maybe, I don't know, maybe this had to do with the advent of like these retail trading platforms, Schwab and TD and E-Trade and all that, like in the late 90s, they really gamified the markets. And then if you think about the stocks that were working, that were making people, at least the opportunity to make a lot of money, whether you're buy and hold, whether it was Yahoo or Qualcomm or Lucent or this and whatever, then people are like, well, I want to trade. I could, trying to trade with my retail broker, calling up Merrill Lynch and saying, hey, buy me 100 shares of Qualcomm. And then later that afternoon selling it, it wasn't really available. So the idea of having all these new inputs, right, for people to trade, maybe it was just a very concerted effort to sell newspapers or, get, more viewership or that sort of thing, or more people commenting on a message board on Yahoo or something like that. But it's here to stay. It's not going anywhere. But now the argument is that the machines own the whole.
Well, that's it. And again, I say this to Mel all the time, and it happens pretty regularly that the numbers will come out and the market will do the exact opposite as what I thought if those numbers had in fact came out. So if you had told me the day before what was going to happen, I'd say 50% of the time I would have been dead wrong in terms of the outcome of the market. So yeah, I think to sort of dance around that, I do think we probably put way too much importance thinking we can somehow figure out how the market's going to react. Real quick, we have an XLE versus ExxonMobil chart, which I think is interesting. And you'll see sort of this catch up that ExxonMobil has had now. And this makes sense. I mean, Exxon is a huge component of the XLE. Exxon, ConocoPhillips, Chevron, it's probably 50%, a little less than 50% of the overall ETF. But what this looks like to me, and again, I think finally these big cap integrated names are starting to get off the mat. And I tell you, I think this performance is going to continue for a period of time here in energy. So we just wanted to point that out.
Yeah, I screwed this up. Amanda and I were talking about this before the show. I really meant to do XLE versus crude oil because then when you look at maybe Amanda can pull up crude. This is my bad. This is one what we've been talking about, this kind of 65-ish sort of range. And, it's bounced off like, I don't know, 66 or so on a few occasions on the crude. And so, here we are now from 65 and a half up to, 71. And if you look at that 200-day moving average, maybe that's the level. So what I meant to show is the XLE, I think, outperforming the underlying, which brings us to copper versus Freeport-McMoRan. This is something that I think you're probably very well equipped to speak to, Guy. I mean, obviously, copper strength is something that a lot of folks will point to about, correlates with the strength of the economy. But Freeport is kind of stuck in the mud here. What's going on in this kind of
this is the market saying, you know what, I don't believe. This is the equity market saying, I don't believe the move in copper, and maybe the move in copper. And we've actually talked about this. The move in copper is predicated or built upon this want to get ahead of the tariff. So there's been a hoarding, which has shot the price up. But the equity people are saying, not so fast there, folks. We are not going to fall into this trap in terms of buying the equity when the commodity is on fire. Because if the commodity starts to do a back and fill, we're going to be left with a term we used to call shiny pants. In other words, we're going to be left with nothing. Yeah, you like that? I think that's exactly what this is. This is the equity market saying they don't believe the commodity market, and they might be right.
By the way, so you and I have done hundreds of podcasts.
I've never used that term before.
And hundreds of fast money. I've never heard you say that.
Yeah, you got to come up with some new material every once in a while. My friend Joe Mazzella talks about, you work, and all you're left with is shiny pants. Or another one of his favorite things is, if he's trading something, if he's making bets and levering something, he'll say, that's Big Jim's money, which I never really understood because I don't know who Jim is, but I always found it interesting.
Joe Mazzella is an old school bro there.
He's a pizza under 300 pounds. He got a perfect.
I've never heard that one.
SAT. Yeah,
that's amazing.
I'm pulling out all the favorites.
A pizza.
He got he got a perfect math SAT, and he basically, I don't think he got one correct on the English SAT, to the point where the administration came in and thought there were two different people taking the same test.
That's amazing. All right.
He always talks about wanting to write a book. And I say, well, in order to write a book, you need to read one first.
All right. I love that. We talked about CoreWeave for a second and what we thought it meant for the whole generative AI sentiment in general in the public markets. Let's talk about it from a different angle. Let's talk about it from Goldman Sachs, Morgan Stanley, and JP Morgan. It's interesting, found its way into this. So the first two, more pure play investment banks. These guys are lead left on almost every major deal in the market. Now, there's plenty of great deals when the IPO market is healthy for, let's call them second tier banks. When I say second tier, I don't mean that they're any worse than the other banks, that sort of thing, right? So I think about this. They really needed Goldman and Morgan to work. They spent a lot of time within tech. They are basically, like I said, they've been on every major tech deal over the last, I want to call it 20 years for the most part, right? And so if you are optimistic about the IPO market, reopening, and I got to tell you, I'm sick of talking about the same, 20 stocks. I would love to see the IPO market reopen and in a comfortable sort of environment. But you said something earlier. The fact that the CEO of CoreWeave went on, I think it was on Bloomberg, before the stock had opened, and said, if NVIDIA did not come in for a $250 million order, now NVIDIA had already, I think they own 3% of the company or whatever, then the deal would not have gotten done before they priced the thing. I mean, they priced it before they had an opening price for the thing. And they raised $1.5 billion. Guy, you can do the math, $250 million out of the 1.5. That's insane to me. So the deal should have never happened either in this market environment, or if these bankers had a good read on where demand was relative to the perceived value.
There was an excitement around that. I mean, what's fascinating is when they probably were talking about this in the fall. I mean, I don't know what the lead time is. They're probably salivating around the thought of presenting a company adjacent in the AI space for the market to sort of pick through and get excited about. And then the world changed dramatically. It probably, if you think about it in terms of timing, it probably couldn't have taken place at a worse time. But, his story will show you that, a lot of these IPOs that seemingly failures over the first couple months turn out to be great successes. And CoreWeave might wind up being that, but we're just talking about the here and now and the optics around it. And the fact, again, that NVIDIA needed to sort of save the day, I find that a little problematic.
Yeah, I mean, like, when you talk about, a stock becoming like, a winner, after an IPO, it doesn't have the sort of hair on it that this one does. $8 billion in debt. It's got a $17 billion market cap right now. Their debt service is huge. Their customers concentration is crazy. Those customers, as we just read that article from The Information, might be pulling back on, the usage of data centers and the like. So I just don't see how this one shakes out, but who knows? But my point, Guy, also about Goldman and Morgan is that, these stocks, like, they're down 20% or so. I think Morgan's down a little bit more from Goldman Sachs. I mean, you might present an opportunity if the market shakes out a little bit. These things come in a bit more. They get kind of sloppy here. And if you think the back half of the year is going to be better, as like we have trade and, some of this stuff kind of tamped down a little bit, the Fed starts cutting rates, maybe for the right reasons, not for, not because the economy is weakening. This could be a good setup. But go to the BKX for a second here. And I'm just curious your take, Guy, because we have an S&P that's flirting with those prior lows, and the BKX is not at those lows or breaking them. What does that mean to you about the banking index in general? And we know that JP Morgan kicks off earnings in 11 days on
there was way too much enthusiasm post-election, in my opinion. There was, all the things that people talk about, the regulation being rolled back, new deal making, optimism in terms of not only the C-suite, but in terms of the consumer. They were all sort of tailwinds for banks, which all those things make sense, but none of them have really come to fruition. I mean, the IPO we just talked about and some of the other things clearly are going the wrong way. So you look at this now and we're through the levels that we saw around election day or so. So we've round tripped, like the broader market, we've round tripped the entire exuberance around banks post-election, which I think is somewhat concerning. I think there's more downside here. I think you'll see bounces along the way, but a lot of these banks, I mean, the headwinds are out there. They are, as much as people want to say it's a secular shift, I mean, the banks are as cyclical as it gets. And, I think we're entering sort of the wrong time to be sort of optimistic about banks. At a certain point, valuation might be compelling and you start to sort of discount a few things, but I don't think we've discounted it yet.
All right, here's one we've got to figure out what's being discounted right here is the chart of the day.
I love charts of the day.
General Motors. This one stuck out to you. This name you've been talking about for a bit. I mean, obviously in the crosshairs a little bit of these auto tariffs and the steel tariffs and, the parts and there's a whole host of things going on here. But you would have thought that if GM, is one of the companies that, you think is a U.S. manufacturer, I think 40% of their cars, Guy, come from outside the U.S. and some really important models from a cost standpoint, some of their lower cost ones. I would have thought this stock would be, I don't know, man, like at least below that range. You know what I mean? Like, so why does this hang in there? What's being discounted right here?
Well, I think this is my sense. I think what the market is saying is we know at some point this administration is somehow going to come to the aid of the U.S. auto manufacturers if they see their stocks sort of fall under significant pressure. And they'll say or do something that, again, will sort of give a lift to these names. And I think what the market is betting on right now is the teeth around these tariffs might be taken out and some carve-outs around a GM and Ford somehow. I don't know what that looks like. I'm not smart enough to understand that, but I think the market is betting. And by the way, it's not unprecedented. We saw it a few weeks ago, if you remember, some noon announcement or so around GM and Ford. And I think that's what the market is betting on now. So I think we're at support levels. I'd be surprised if we broke those support levels. But I think, believe it or not, somewhat counterintuitively, I think you're trying to play GM from the long side here.
Yeah, maybe, some sort of option strategy, define your risk a little bit. What do you think, though? And again, Trump's talk over the weekend, was pretty clear. I mean, that they weren't going to do any major exclusions and weren't going to back down, that sort of thing. And, listen, I take issue. I say this, I've been saying this for, 8 years. I just don't think he's a particularly good negotiator. And I think 8 years or 9 years into people kind of understanding how he operates, it just loses, some teeth to it. Maybe a guy like Besant is emboldening him, or Lutnick, who's the Commerce Secretary. But generally, the guy doesn't get emboldened and he doesn't get deterred by too many things. And I just wonder if we're likely to see, some folks, our trading partners, maybe the allies too, just kind of try to call his bluff a little bit, because in many ways, our stock market is saying something very different about a trade war than, let's say, the European stock market, right? And I know that's not always a great lens to think about this, but I think that if we really put a bunch of these reciprocal tariffs on at the levels that he's talking about, not just our economy is going to slow down, the global economy is going to slow down.
Yeah,
And
well,
honestly,
we had Vinny. Yeah,
more.
you're right. I mean, we had Vinny Daniel on what 3 weeks ago, 4 weeks ago on the Risk Reversal podcast, and he talked about sort of the irony of in these policies are actually making European stock markets great again, which to a certain extent makes sense. I mean, these were sort of left to the wayside for 20 years, and now when they seemingly have to sort of invest in themselves and it becomes very, very beneficial to their markets. And that's what we're seeing right before our very eyes. We have a real quick question. This is from Michael Graham. Liz is not here, but is it moving the 2-year yield enough to say that this could be Liz Young's Thomas re-steepening event ahead of a recession? She's talked about that for the last couple of years, that it's not the inversion that gets you, it's the re-steepening, and the re-steepening typically takes place ahead of some sort of economic event. So yeah, it very well could be. We're obviously seeing 10-year yields back up a little bit. I think it's sort of this flight to quality. Doug Cass correctly points out that, today could be a strange day in terms of quarter end and some of the moves we'll see. And that's true. I think it's playing out right now, maybe out of equities into bonds or vice versa. We'll see how it plays out. But yeah, I think to the question, to Mr. Graham's question, I do think this could be the re-steepening ahead of something. And real quick, and this we just answered, but this is from Fatal 999's8. Why is the media focusing so much on autos when they should be looking at the semis? Great question, because we have a SOX chart for you. So let's throw that SOX chart up, because we have been focused on this, Dan.
Yeah. So what I find interesting about the SOX, the SOXX, the ETF that tracks the semiconductor index, is that it's down about 30% from its highs made, in the last year. And you have a NASDAQ, as we talked about, that's down, maybe the NASDAQ 100, about 15%. So it's doubled up, the downside of that. And so you look at this one, and I know you've been calling for it. It looks a little different on the SMH, which is, much more heavily weighted towards NVIDIA and Taiwan Semi, which is one of the reasons why I like using the SOX here. I think it's a better representation of like a broader group of these stocks. You're kind of at that breakout level, right? 175 was kind of the level here. And we found ourselves, what was the high in that? I'm looking at it here. It was about on the all-time high.
70 something, I think.
Yeah.
Right?
So here we are, we're down 30% or so. And, the question is like, if this leadership, was a really important part of the last 2 years' performance of the NASDAQ and the S&P 500. What happens here? Because this thing's been trading very poorly for a while. Maybe Amanda can pull up Microsoft over the same time period. You've highlighted this a little bit. They don't look too differently. And Microsoft was one of the early beneficiaries of their investments in OpenAI and the excitement in and around the technology, not just from them integrating the technology into a lot of their products and services, but also, the compute that a lot of their customers would rent or use from Microsoft Azure, which is their big cloud platform. So again, Microsoft doesn't look too different, but the fever's broken in these names. And I just don't know how they get them back going again, because we're really starting seeing some of the kind of kinks in the armor, if you will, about this CapEx spend, which I believe has been a huge part of the sort of economic growth that we've seen, and obviously powering a lot of the returns in the stock market over the last 2.5 years.
I think it's right to bring them up without question. Real quick, I just want to touch on a few things. JS says, dang, that Dan N has some good questions. Jay,
right?
Well done by you.
Thank you.
Eric Lancelotti, quarter reminder, look at the HYG breaking the 200-day. It's breaking the 200-day, as Eric knows, on the way down. I think it's trading 78 3/4 or so. So this is not something we advocate trading. We talk about the HYG just to sort of pay attention in terms of what's going on in the high yield market. So there's clearly been something going on recently, breaking down through there in a pretty meaningful way. This could be something that nobody's talking about yet. I'm glad you brought it up. And then real quick, any update on Liz Young? That's from Roha Buckingham. I thought we did. Liz had a son a week and a half or so ago.
March 18th on my anniversary.
So there you go.
Griffin River Thomas. Heck of a name. Absolutely. Look at
There
her.
you go.
That's great.
And that's Liz, her husband, her son in the New York skyline. That's a nice picture.
On Twitter, we're not doxing her. It's out there.
No, we don't dox people.
We're really happy for you. Great question. Thank you for that. I think we had one other thing. Oh, all right. Let's just say we have a somewhat of a protracted trade war. We've been talking about consumer staples, which have actually been having a hard time, I think, fundamentally dealing with a whole host of things as it relates to trade and tariffs, but also some of this pushback as it relates to the use of, the GLP-1 drugs and stuff like that. They're starting to feel an effect of that. Who should benefit in, let's say, a trade war that lasts longer than we would say? And we're just going to pull the Walmart chart up here because I think you and I were both in the camp that things got way too exuberant into their print. You see that gap. It kept on going lower. This goes back to late February. Here we are. We're trying to consolidate a little bit. Valuations come in a bit, Guy. The technical setup, you could say, it doesn't have to.
No, I mean, Walmart could theoretically be a winner. Everyday low prices. I mean, people are going to, again, in an environment where prices are going higher, where I think the consumer is strapped. Listen, nothing has really changed at Walmart in terms of their performance, other than the valuation got ridiculous and the stock is sold off. But they continue to be a great operator, and they continue to see this trade down, which benefits them. So the stock, and I rarely use this word. I think this sell-off, by the way, it's lasted longer than I thought, and it's probably deeper than I thought, but I think it's created some sort of opportunity here. So yeah, I think Walmart could potentially win. I mean, they seemingly win in just about every environment, but this could be an environment where they really start to make hay, as they say.
Well, and again, if you're looking at this thing and you say, from the fundamental standpoint, I mean, the technicals don't do a lot for me here, Guy. You'd have to say to yourself, everyday low prices. You think the kind of trade down, to a Walmart. We've seen what's happened on the lower end, the Dollar Tree and the Dollar Gen, that sort of thing. I mean, this is kind of where you'd want to be, and it's somewhat de-risked here, but maybe you keep a really tight stop on it. Maybe it looks something like that 200-day moving average, it's 83.5. I want to get one question here. This is from Gregory C. Guy. At what point would Dan N buy Tesla? So this is a really interesting one. And I can't wait to see what the delivery number is tomorrow. I think the expectations are that it's going to be really bad. You and I talked about this when the stock was like 225. We said, not a good press. You were kind of targeting a 285 level. That was the 200-day moving average for a bounce. So here we are. We've given back, let's say, a little more than half that bounce. Maybe it's sort of 2/3. I think a poor number is baked in the cake. I think consensus for deliveries was like 420 a month ago. I think it's right now maybe 370. I think there's some folks who think it could be as low as 315. So when you start having that whisper number out there that low, and you just have a piece of data, one piece of data on the deliveries, and you have to wait a couple weeks or so to their earnings, it's a tough one. Now, I am firmly in the camp that this is an auto company. And I think all the stuff that Elon has convinced folks about is full self-driving, leads to robo-taxi, leads to robots. He just put together XAI, which is his AI company, with X, which is formerly Twitter. I mean, I think he's getting to a place where he wants to merge as much of these things together. He already did with Solar City, I want to say 7 years ago, when that business was failing. So I don't know what else comes of this. If XAI is bought by Twitter or Tesla at some point, and maybe you can make a better case for full self-driving and robots, all that sort of stuff. That seems to be something that'd be a trend. I just can't imagine that shareholders of Tesla would be interested in that. So I don't buy the robo-taxi. I don't buy the robots. I take the over on all that. So to me, I don't see any reason why this stock couldn't go back to $150 where it was trading a year ago.
Yeah, I think the Jefferies analyst has a $140 price target. But along the way, they're going to be, if it gets there, they're going to be buying and selling opportunities. I think we've done a decent job sort of putting out levels. I mean, last quarter, I think it was last quarter, when they announced, I think the stock was 390. The quarter was miserable. I thought it should trade lower. It traded at 418. We clearly thought the fundamentals were sort of not being looked at. The subsequent move, to me, made sense. The overshoot through sort of 230 was exactly that, an overshoot. The bounce to 285 is what we thought would happen because we talked about it. And now we're sort of doing this sort of downdraft. But I think, to your point, if the numbers aren't as disastrous as the street thinks or is looking for, then you could see another bounce. I think it's all, at this point, bounces on the way to lower prices, though, as Dan just said.
Yeah, one other thing I'll just mention is that there was an article, I think it was in Bloomberg over the weekend or maybe this morning, talking about, oh, it must have been this morning because Elon was at some political rally in Wisconsin. He's saying that his what I'm paraphrasing, his work with Doge, right, which is the cost cutting endeavor in the administration, is hurting his stock, and he made it sound like a little bit of a conspiracy, like folks are trying to push it down, all that sort of stuff. At the end of the day, the reason why a stock goes down is the reason why it goes down. You know what I mean? Here, there's a whole host of reasons. I really do think it's on fundamentals. There might be some pushback against him and his political leanings and some of his activity away from Doge too. But if you look at the move in which the stock, from November 6th up until its highs in late December, well, what did that have to do with? You know what I mean? That was not fundamental. So on the way up, like it was the hope of all this other stuff. And in those quarters that he reported late last year, he just really pivoted from the auto stuff to the other stuff, the pie in the sky stuff. So I think, gravity usually takes hold in the stock market or in most markets. And I think that's what happened. So let's just see what the delivery number is. Maybe it bounces on it if it's not as bad as you expect. And then let's see what the margins are and everything like that when they come out to report. Because you and I thought when they reported in January 28th or something like that, when we were looking at this number, there's no reason why the stock should have been up. And it was still, the fever hadn't broken yet. The fever's broken. Let's see how it acts on the fundamentals of the auto business when it reports numbers tomorrow as far as deliveries and then results in a couple weeks.
We'll be back tomorrow to discuss, regardless, at 11 a.m., the market call. In the meantime, podcast will drop. Dan and I did a little risk reversal media podcast this morning, so check that out. Much different than we just talked about here. Again, at the end of the week, jobs number, I think that's going to be fascinating to see the market's reaction to what I think will be a miserable number, but we'll see. And as Dan and Doug Cass point out, today is, in fact, month-end, quarter-end, so you can still see a lot of strange movements by the end of the day.
By the way, really fun pod for you tomorrow, Guy, on the Risk Reversal podcast. You and Danny Moses are doing the Risk Reversal pod. So that's going to be a pre-Liberation Day podcast with you and him. So a lot of great stuff this week. We have, I think Carter's going to join us on the market call. We have Danny Moses, obviously, tomorrow. We have Josh Brown of the Ritholtz Management. That's going to drop on Friday. So we got a lot of good stuff going on here. Carter's on Thursday, as Amanda just said. So stick around. We got a lot of stuff going on. We'll see you guys tomorrow.